Hello, everyone. My name is Greg Phelps. I am the president of Red Rock Wealth Management. This is being produced through my blog RetireWire as well, retirewire.com. And today, what I wanted to talk about was the concept of structured notes. What is a structured note? How does it work? How does it fit in or not fit in with your investment portfolio? Does it make sense to use them? Should you avoid them at all costs? And a lot about the negative press or the bad rap that they've gotten in the markets or in the internet searches today. So we'll kind of cover some of those things and why and how and the difference between those and the actual structured notes that we use personally here with our clients. So let's go ahead and dive right in. The first thing to discuss really is what is a structured note. Now, when I've asked this question to clients before, I would say upwards of 95 to 96, 97%, most people just don't know what a structured note is. So I'm guessing that that's probably where you fall in as well on the scheme of understanding everything about them to understanding nothing about them. So we'll just kind of start with what is a structured note. The first thing to understand about structured notes is they are a debt obligation. So at the very fundamental level, a structured note is actually a bond issued by a company like Goldman Sachs, JP Morgan, things like that. The big banks, they issue what's called a structured note. So it actually is a bond, but it actually has a different component. So it's a bond, but it's paired with derivatives, things like call options and put options. And real quickly, I don't want to go into the nuances of these things, but a call option is the right to buy a security at a certain price for a certain specified time. So I have the right to buy Apple stock at $200 a share between now and the next 2 years. And if Apple stock goes up to 300, I'm going to buy it at 200. If Apple stock goes down to 100, I'm not going to buy it because my option's at 200. And a put option is the opposite. A put option is the right to sell a security at a certain specified price at a certain specified time. So if Apple is trading at 200 and I buy a put option to sell it at 210 in 2 years, and if the stock is actually trading lower than that, you would exercise that right to put that stock to the person who sold you the option. And then there's a lot of different convoluted strategies that go into buying and selling calls, puts, various different things, futures or longer term contracts. I'm not going to get into the nuances of those. I started off my career back in 95 and I did trade a lot of options, so I understand them. Most people don't. If you do have a little bit of understanding, then you're probably a little bit ahead of the curve when it comes to structured notes. But just understand that a structured note is actually a derivative security. It actually derives its value off of some other investment. A structured note is also a hybrid security. And what I mean by this is, while it is a bond instrument, it is a debt obligation of the issuer, it has also got some equity components to it because of those derivatives that are buried within the structured notes. So a lot of this seems like a black box. And to be frank, it is. I mean, every different note that we do, we could break it down and say we bought this many calls at this strike price and we sold this many puts, but it is kind of a black box. Unless you understand the nuances of how all of these different options and derivatives work within the structured note, you probably aren't going to understand that black box. So it's best just to focus on what can this black box called a structured note do for me or not do for me if certain conditions are met or avoided, and then you can kind of digest the risks associated with that and go from there to decide if it's right for you and your investment portfolio. So let's talk a little bit about what structured notes can actually do for you. Well, some structured notes that we use, they give you downside protection, meaning that if the S&P is trading at a certain level and you're afraid it's going to drop in 3 years, it's going to be lower than it is today, you can actually create a structured note that if the S&P is, let's just say, no worse than 20% down, you might get a 4% per year payout or something along those lines. So you can actually structure a note that will give you some bells and whistles. That's what I like to call them because that's the only way I can refer to them, is bells and whistles. So you can actually have downside protection on a structured note based off of where the market is today. Right now, we're approaching all-time highs again, so downside protection sounds pretty good. So that's what we've been building into our structured notes. You also can get upside participation and possibly leverage. And we'll go over an example of a note that I'm actually closing on, or I just closed on last week, and we'll talk about that. But you can actually get upside participation. So if the index does X, you will, or if it goes over a certain amount, you'll actually participate one for one on that amount above wherever the index closes. If the index in 4 years is up 30%, and that's your digital, which we'll call it on a structured note, but it actually ends up being up 35, you'll still get the 35. So you get the upside participation. It's possible we can structure these with leverage, which is the one that I'm doing right now as well. Whereas if the note is above a certain level, you might get 1.2, 1.4 times whatever that index is. And this is all done, like I said, in that black box, which seems a little voodoo, but it's all done with derivative securities in addition to that structured note or the bond component. You can also structure them to give you a stated payment at maturity if conditions are met or avoided. That's typically what we do, is just it's a certain term, a 4 or a 5 or a 6-year term, and you're going to get a certain payment if certain conditions are met or avoided, but you don't get anything between now and then. So there's a lot of reasons why we look at those. And additionally, you can have certain interest payments that if conditions are met or avoided, you might get certain payments over certain periods of time. If the market does X, you're going to get a payment of 3% every quarter, that type of thing. So there's a lot of different bells and whistles that you can put into these structured notes, and they can be very, very complex. But at a fundamental level, think of it like the black box. You don't necessarily want to understand how the car works when the gas goes into the tank and you turn the ignition, but you probably do want to understand that you're going to get from point A to point B. What type of structured notes are there? Well, just a few of the basics. You may have heard of principal protected. So, and I'm going to talk about the risks in a second, but principal protected basically is that the issuing bank is going to say, we will give you your money back. If you put $1,000 into this note, we're going to give you that money back no matter what. Now, keep in mind that's subject to the credit of the issuing bank. So while it may be quote unquote principal protected, and we'll talk about this with the Lehman collapse here in a few minutes, it's only principal protected based on the good faith and credit of the issuing bank. There's also buffered notes, which means that it'll give you, for example, a certain percentage of downside like we just discussed. So if the S&P is trading at X, and if it's down no worse than 10%, you'll get X back. So the S&P in 4 years could be down 10%, but you're going to get 100% back. And so there's those buffered notes that give you a little bit of downside protection. Again, everything is going to be subject to the credit of the issuer. That's one of the biggest risks that we'll discuss. There's also return enhanced notes. So you can actually get a note where you may be looking at a fixed income type of investment and bonds are trading at 3%. You might be able to structure a note in such a way where with some options derivatives behind it, you can get a very high likelihood of 4 or 5%. So based off of market conditions, you can improve your fixed income return as well. There's market linked CDs. So they are FDIC insured, principal protected, but they're going to have different caps and so forth. So you're not going to get the full participation of the stock market. However, it is linked or tied to the performance of the stock market with your guarantee of principal back. There's a lot of different types of structured notes, too many to actually go into, but those are just some of the main ones that we'll kind of touch on today. So how do these things actually work? So here's that black box, and I'm going to deconstruct it for you as best as I can, but on a very high level because they're very complex. First of all, you take a bank, Goldman Sachs, Barclays, JP Morgan, HSBC, Credit Suisse, you name it. All the big banks are doing these today, and they've been doing them for decades. But you take a big bank, and they need financing, just like McDonald's does or Coca-Cola does. So they'll say, we'll issue a zero coupon bond, and a zero coupon bond effectively is issued at a dollar amount that is less than its par maturity value. So in this situation, we're just going to use very rough numbers here just so you can kind of gauge how this works. You put $1,000 into the structured note, which means that $825 actually goes to the bank. So Goldman Sachs, let's just say, out of that $1,000 you put in, $825 they take and they use that however they want to. And that's the bond component. That's the zero coupon bond component, because that $825 over that time frame of 4 or 5 years, whatever the rates are at that point in time, they will actually pay you $1,000. So that's where you get that principal protected, or they might pay you, a guarantee of 90% of it, depending on how it's structured. But that's where the bond component is. That's a zero coupon bond. The government issues these as well, so they're nothing new. It's basically a bond that's issued at less than par, that matures at par, and it doesn't pay you an interest rate along the way. That remaining amount, that $175, the majority of it is going to go to buying and selling those derivatives to get you that structure, those bells and whistles that we talked about. And we'll, again, go into the details on a couple different ones here in a second. But that $175 is going to go to buy some calls, sell some puts, sell some calls at a different strike price. And all of these structures come into play. You own all of these options, these contracts, which, by the way, for grins, these contracts, they're not unique. I mean, they've been doing this for hundreds and hundreds of years. For example, a farmer will say, hey, I got a crop of corn. I don't know if it's going to rain or not next year. I'll sell you the right to buy my crop at a certain dollar amount per bushel. And so they will pocket some money, and it helps them reduce their risk. And on the other side, the investor in that might have a big gain as well. So these contracts are nothing new. A small amount of that 170, or actually of the whole 1,000, will go maybe 1 to 2%. It's typically a quarter of a point to 50 points, 50 basis points per year. So it's 1 to 2% or so that's going to go to the issuing bank. They have to go and create a QSIP, a legal document. We also use a company that goes out and shops these for us so we can get the best bells and whistles. So that 1 or 2% goes to the issuing bank and the shopper, so to speak, which a company we use is called Axio right now, among others. But so there's a very small amount that goes to somebody else. One thing to keep in mind is that when you do look up structured notes, and if you're considering these for your own investment, there's a lot of negative press because a lot of them were built with very, very heavy fees and commissions. You would see fees of 3, 4, 5%. We'll talk about Wells Fargo in a minute, but those fees, they reduce your bells and whistles. They take your bells and whistles from a level of, yes, this makes sense to me, to, no, there's no way this makes sense to me. And so none of the notes that we use or we create or use with our clients have any commissions built into them whatsoever. So if you do see that on the internet, just keep in mind, they're not talking about the notes that we create or the ones that we endorse for use with our clients. Some of the features that you might find on these notes are auto call, meaning that if you've got a 5-year note, think of it like a 5-year bond with the bells and whistles. If you got a 5-year note, there may be points in time where certain conditions are met. If the S&P is at X and it goes to Y, no matter what, they're going to give you your money back plus whatever they owe you in terms of the performance of that. And they don't have an option. That's just an auto call feature if certain conditions are met. There's also notes that are callable, where the bank, the issuer, Barclays, may decide, hey, we've created this note for you and we put these calls features in and we want to take it back. And so they will, again, pay you your principal plus whatever performance they owe you. Typically, if they're call-able, that means that Barclays may be going out and refinancing that zero coupon component of the bond, or they may have better bells and whistles that they want to do at some point in time. There's a lot of reasons that a bank may call that from you. We typically try to avoid the callable stuff. However, there may be points in time where we would use it. There's also a capped structure. I talked about the market link CDs, where I'm going to get my money back, and I have a very high expectation. If the market goes up over the next 5 years, I'm going to get 5% a year. So that cap might be that 5%. The market could go up 10% a year, but you would only get 5% a year of it. So there's cap features. And then there's also participation rates. For example, if the S&P goes up 20% over the next 4 years, you may only get to participate in 80% of that because of the way the note is structured. There's a lot of trade-offs in these bells and whistles, and there's just an infinite way that you can structure them, which you're probably already picking up right now. And then there's leverage notes, which again, if the S&P goes up 20% over the next 4 years, and if it hits these certain marks, these watermarks, you might get 1.5 times. So the S&P could go up 20%, and you might get 30% on that payout in that 4th year because of the leverage involved. Again, black box, very voodoo, but I know how the options work, and if you spend enough time researching them, you'll kind of understand as well. Another thing that I just briefly touched on is, and again, I want to make sure that I drive this home, is that there's a big worry out there, and there's a lot of scuttlebutt on the internet about the fees and the commissions and how they're so expensive, and the expense of these things takes away the allure of them. I understand that. I would never buy one of these brokered CDs that has a 5% commission in it or a 3% commission, because that is taking away my bells and whistles. It just doesn't make sense. And a lot of those products, they're just sold. They're created as a proprietary investment, and the broker goes out and they sell them, and they get their 3%, their 5%, and they're happy. They walk away. They're not doing planning. They're not helping you achieve your goals. So I want to make sure that everybody understands we are a fee-only financial planning firm. We do not accept any commissions. None of the notes that we create have any commissions in them. In fact, it's quite a bit of extra work to create these things. However, we get the satisfaction of knowing that we're doing everything for our clients that we possibly can to make their plan work. The shopping fee I mentioned is, there are companies out there that will go, I'll create a structure. I'll say, I want a structure that does this because the market's done that. I want to put this in my client account, and they'll go shop 10 of the different big banks or 5 of the different big banks because they all price these options differently based off of how their business is structured. They may be better at calls or puts, or they may be better at certain structures. They may have a better financing rate. So there's a lot of different bells and whistles, and that's why we do pay a shopping fee, because we just simply don't have the time or capacity to go out and call 10 big banks and say, hey, shop this for me. So there are shopping fees, that's what I call them. Again, commissions, none. Keep that in mind. If you see anything negative about the notes, typically it's about the commissions. None of these notes have commissions in them. So here's the most important thing that I want you to take away today, if you're even remotely considering structured notes as an investment for your portfolio, and that's the risks. It's very, very important to understand that there are downsides to these things, because once you see the upsides and how they work, again, you might think it's too good to be true. A lot of people do. There's a lot of downside, so you got to keep that in mind. The number one thing is creditor risk. And the creditor risk is basically the risk that it is a bond. You are loaning money to a big bank. If that big bank goes out of business, that bond may be completely worthless. Even if the underlying assets, the derivatives are worth something, that bond could be completely bust. So you could lose 100% of your investment, but the reality is you could lose 100% in any bond investment. You could lose 100% in any stock investment. This is really not much different, but you need to keep in mind the creditor risk. It is an additional risk, and it's probably, in my opinion, the most important risk to consider. Again, we'll talk about Lehman here in a minute. There's also market risk. If the stock market doesn't do well and you're tied to the stock market, you could lose your principal. That's entirely possible, entirely likely in a bad market, but that's really no different than just investing in the stock market anyways, because that's just typical market risk. But we kind of need to hit people over the head with that to make you realize you do have market risk with some of these notes, depending on what they are and how they're structured. Liquidity risk. So now we get into the more nuanced risks. These notes are created to do a certain thing at a certain point in time. Not everybody wants that certain thing at that certain point in time. So if you go to try to sell this note, if you invest in a note today, and in a year you say, hey, I need my money back, I want to buy a car, whatever it is, you go to invest in this note, it may not be liquid like any other share of Apple stock or any other government bond would be. In fact, I can tell you it won't be that liquid. That bond or that note, that structured note, then gets shopped on the open market to buyers. There are typically buyers out there, but they're going to give you a big, what we call haircut in the industry. So they're going to, it may be worth, the intrinsic value of $1,000 investment may be worth $1,500. They might offer you $1,100, because that's how they're going to capitalize on that risk, and how they're going to capitalize on the fact that they didn't create the note. It didn't work for them. So they want that extra bit of return. So there is liquidity risk. You can typically sell them. They're not entirely liquid like any other investment. And that's why we tell people, I kind of joke around. I say, you know, put it in a shoebox in the back of in the closet of the back of your mind for that 4 years, for that 6 years, and just forget about it. And that's why we only put small amounts in them, because that small amount is not going to change their life. So that's just something to think about, is the liquidity risk. There's also pricing anomalies. Since these things do vary in structure, in term, in the bells and whistles, there are pricing anomalies that will exist as well on your statement. So if this is in your account, you might look at it, you might have put $10,000 into this note, and it may price at $9,500 day one, just because it's not necessarily liquid. It's a structure that you wanted, not necessarily the rest of the population, and it's going to change. Those pricing things are going to change based off of market conditions. They're going to get closer and closer to the intrinsic value as you get closer and closer to maturity. But before maturity, there's so many variables that it may be worth, you know, that $1,000 may be worth $1,100 in the first year, and on your statement it may show $9,000. It's just one of those things. You can't focus on the price on your statement. There's also the call risk, as I mentioned, that the bank could actually take that away from you. You may have a great note that you love that's performing incredibly well, and the bank comes and says, here you go, here's your principal, here's your performance payment that we owe you, and the bank could make out on that. So I'm not real huge on the call features. Generally speaking, however, there might be positions where it makes sense. And so that's the prepayment risk as well, that they may prepay you. You've got this investment in mind, you've got it built into your plan, and they may take it away from you, giving you your principal and whatever performance back, but they may take it away from you. Then you have to go and reinvest. So it's really a reinvestment rate risk as well. The exchange rate risk exists in every investment that is not dollar denominated. So if you have an international investment and they're investing in euros stocks, and they're using euros over there
in Europe,
it's there, you've got that risk that the euro is going to fluctuate up or down in value against the dollar. But that's the same with every international mutual fund or every international ADR that you might invest in. And so those things are very normal for the course of investing. There's also the fees and commissions that I mentioned. They can be huge. I put that under a risk because, frankly, if you don't know what you're getting into, it could be a massive risk that you're just blindsided with. The downside, the biggest downside is you don't get the dividends. If you buy the S&P 500 Vanguard index fund, you're going to get the dividends, and those dividends are around, depending on when you look at it, 1.5% to 2% a year. Let's just use 1.75%. So that's 1.75% payout that you would get every year that you don't get in the structured note, because remember, you're not buying the index, you're not buying the stocks, you're buying derivatives and options within or that are surrounded by that index or based on that index. But those options do not pay the dividends to you. So you've got an automatic loss. If you're comparing apples to apples, my index fund versus my structured note, you've got an automatic loss of whatever the dividend payout is over that period of time, whether it's a 3 or 5 or 6 year note. Keep that in mind. We always do our analysis and we assume that we've lost that money. And then we already say, well, does it make sense? Then we say, well, does it make sense even without that dividend payout? So that can cost you 1.5% to 2% a year. So that's a big downside for most structured note investors. How are they taxed? First of all, obviously, consult your tax advisor. We cannot do the tax returns for everybody or anybody. We are not a CPA. We cannot give you that advice. However, generally speaking, any structured note that's going to pay you interest payments, whether it's quarterly, semi-annually, annually, that's going to be taxed as ordinary income in the year that you get it. Any structured notes that don't have that payment, they just have that final payout on year 4 or year 6, that's going to be taxed as a long-term capital gain. Generally speaking, there could be some phantom taxes involved with the principal protected notes, so it can get a little dicey. However, generally speaking, most of the notes that we're going to look at are going to have that one final payout. They're going to be a long-term capital gain. The other thing to keep in mind is it sounds great to use these notes in some form or fashion with some clients. However, you put $10,000 in, you get a $15,000 payout in year 5. Well, you've got now an extra $5,000 of long-term capital gains. Just keep that in mind. It's a big chunk all at once versus little chunks over the year. And again, comparing and contrasting, you would have had dividend payouts and possibly capital gains over the course of the year from your mutual fund. This just defers them and you get them all in one year. Now, the good thing about structured notes is, for what we use them for, is really to kind of target a more narrow, more defined expected rate of return. So we may forego some of the upside based on market conditions to have a little downside protection and give us a really high likelihood of achieving, let's just say 7% a year, 8% a year, which is a couple of the examples I'll talk about in a second. So we can get a more predictable rate of return. And the trade-off on that is the credit risk, and it is that maturity and the liquidity risk. So the trade-off is you really don't want to sell it for whatever 5 years. You do have the risk that Goldman Sachs goes out of business. But the good part of that in terms of your financial plan is you can say, well, we expect a certain rate of return off of the US stock market, and let's just say that's 7%, and we can structure this note that gives us a really high likelihood of making 8%. Now you can kind of dial in that range of returns. And this helps especially with retirees, near retirees, things like that, where you want to bring the risk down. You want to bring that volatility down in your investment plan in your portfolio. It is a diversifying investment as well. It's a hybrid security. It's not a stock. It's not a bond. It's very different, very unique. You can also hedge downside risk. So for example, right now, we're almost at all-time highs again. So now we're looking at and saying, well, if the market just goes sideways for 4 years, what would happen? If the market goes down for 4 years, what would happen? You can actually hedge some of that downside risk and say, well, if the market drops 20%, we're still going to get a 4% payout. It sounds too good to be true. I understand that, but different market conditions may warrant those types of strategies. You can also structure them for current income. You can have it pay whenever you want. You can do all kinds of things with the income payouts. And a lot of people will use these things, for example, like I said, the market link CDs. Potentially you get a little bit higher payout than the bank would offer you. with no risk. So you're going to forego the whole upside of the stock market, for example, and take maybe half of it or a third of it, but you've also got a guarantee of your principal returns. So there are ways you can structure those. And again, I mentioned sideways market. Being at all-time highs right now, the market may be sideways for 4 years. The market may be up, it may be down. Nobody knows. But we can then again narrow that range of return, and with a portion of your portfolio that would say, hey, if we do go sideways, we're still going to get 7%. So there's a way that you can structure notes with that. We've also got the leverage factor. You can actually get a better performance than what the market does, and potentially higher yields as well than what you normally would get with a fixed income investment, just due to the structure and the different type of security that you're investing in. I would say one thing that they make a lot of sense for is defined benefit cash balance type of plans, because they have a very specific investment target of usually it's 4, 5, 6%. So understanding that you only have to meet this 5% number, you can actually structure a lot of downside protection and cap your upside at 5% and give yourself this ultra high likelihood of getting that 5%. So those types of accounts are wonderful for structured notes. How do they fit into your portfolio? How are we using them? Number one, the most important thing is you need to keep your risk tolerable in terms of the issuer. If you're not buying in individual corporate bonds or even municipal, some of the municipals now, look at California or Illinois, are quite risky as well. So if you're not buying those, you need to consider this risk very, very carefully and keep that credit risk tolerable. If you've got a $500,000 portfolio and you're risking $5,000 on a structured note, that's probably tolerable. It's 1% of the portfolio. But if you're risking $50,000, it's not. So keep the credit risk tolerable. Typically, we look at an overall portfolio of about 5 to 15% of the overall allocation. So if with $1 million portfolio, we're looking at somewhere in the range of $50,000 to $150,000 that we would consider for structured notes. Typically, it's going to fall in the middle, about 10%. And it doesn't just stop there. One thing that people need to consider is when we use a structured note to fill an equity component in your portfolio, those dollars that we use to fund the structured note with are coming out of the stock market as well. So you've got a US stock fund, and then you've got a US stock fund based structured note. So that's asset to asset versus, because it is a hybrid security, you could look at it as a bond and so forth. So you need to consider that as well. 10% of each asset class would probably be the maximum that we would consider for structured notes. So in a $1 million portfolio, most of our clients are around the range of 60% stock. That would give you about a $600,000 stock allocation. If you just stuck with that 15% max, that's $150,000. And if you just did it all based off of the stock allocation, now that's $150,000 out of the $600,000. And if that's $600,000, if you're just looking at US equity, if you're doing a 60-40 split on US to international, now you've got your structured notes that are 41% of your US stock allocation. It's unacceptable. So you've just got to consider every little nuance of your portfolio, the asset allocation, and how you would use these, and keep that in mind as far as the credit risk. Another important thing is that, and a lot of clients have said, hey, this sounds too good to be true. Why are we only doing 10,000? Why are we only doing 20,000? Why don't we do 50? Why don't we do $100,000? And the problem is it just doesn't make sense to me, because it's too much in one security at one point in time. It makes a lot more sense to layer these in over time, because you get different entry points. The market's high, the market's low, the market's sideways. You get different entry points, and it's going to help you kind of defer or diversify the different structured notes that you have. So for example, if we're in a bull market, which we have been in a bull market, but if we're in a really strong bull market, I'm going to be far more concerned about downside protection. The market's already risen quite a bit for quite a long time, and I'm more worried that the market's going to drop 20% over the next 4 or 5 years. I might structure a note that says, hey, I'm willing to only take 5% on the top. At 5% a year, I'm fine with that. I'm more worried that the market drops. I want 20% downside protection and at least get my principal back. So that's an example of what you might look at in a condition like today. And conversely, if we were in a big bear market, 20% down right now, and it had been prolonged for 6 months, and everybody, the sky is falling, the street's red. If you're looking at a situation like that, well, the market's already dropped. We've already lost X amount of dollars. Your US stock funds have already lost X amount of dollars because the market's been bad. I'd be more interested in upside leverage, not as much downside protection, but what can I get on the upside? So you structure different notes for different market conditions, and layering them in over time just makes a world of sense. Another thing that I mentioned as well is, why don't we do 50,000 in one instead of 10,000? Because we want to diversify the credit as well. If you've got risk of a corporate bond, you don't just buy one corporate bond, you go buy 10, you go buy 20. You diversify the risk of the issuer across multiple issues. So if we do a Goldman Sachs structured note and it goes under, well, chances are really good that the other structured notes are going to be just fine, kind of like a mutual fund. You have a mutual fund with 100 stocks and you've got 10 that go under. Well, the other 90 are probably doing really well. So it's credit diversification against the risk of default from a major bank. How do they fit into your portfolio? Why would we do them? Again, we strive to enhance returns as much as possible. We're strong believers in passive investing. These are passive because we're not timing and trading the market. We may be looking at market conditions and structuring things a little bit differently, but we're not timing and trading the market. So if we've got a projection, for example, right now, I believe our projection's around 6.5% on the US market. So if we expect over the next 5 years, the US market's going to do 6.5% return annualized. If I can structure a note that provides a little bit of downside and I'm not going to say guarantee because there's no such thing as a guarantee with investing, but if it gives us a very high likelihood of getting 7 or 7.5% per year, and maybe limiting some of the upside possibly, or having a few things that don't work out, a few structures that don't work out, it's something to look at, something to consider. And again, we also use them for a little bit of downside protection. And as you'll see with the examples, in a sideways market, they can work really well as well. And I've heard that a lot lately from other advisors. Well, we expect the market to be sideways for the next 4 or 5 years because it's been so good. We're probably going to have a bear market and then maybe it'll bounce back. Nobody knows. You can't predict it, but it does help in a sideways market as well. The maturities should be something meaningful. And what I mean by that is there are structured notes you can get for 1 year long or 2 years long, but there's no consistent track record that'll give you any sort of solid foundation to believe that something X will happen over the next 2 years because it's just too short a term. Typically, you're going to have a full business cycle in 4, 5, 6 years, something like that. You're going to have some ups, some downs, but you have a better idea that the growth of the economy is going to buoy the US stock market higher over 5 years, maybe not 5 months, but 5 years. So the maturity should be meaningful. 3 to 6 years is kind of our target. We would probably never even look at a 3-year note. That would be an anomaly, but 4, 5, 6 years, because chances are very high that something will happen 4, 5, 6 years like it has historically versus 4, 5, 6 months where it's just random noise. So ideally, when we build these into your plan, the goal is to have a greater chance of meeting your financial plan objectives. Again, if we expect 6.5% and we can structure a note that gives you a very high likelihood of 7.5%, even if it's $10,000 or a small 1% of your portfolio, that's just working around the edges to add value along the way. So we're going to talk about a couple examples. One of them is one that we did last year, late last year. One of them is one that we just did a couple weeks ago. The first one is the Goldman Sachs Euro Stocks 50 note. A little bit of history on this. I started working on this in the fall of 18 when the international markets were in the doghouse, and they still are, but they were substantially worse off than the US markets. The US markets hadn't quite faltered yet. They did that later in the year, December, January. And so my thought process was the international markets are so much worse than the US markets. I'd rather structure a note on that. The Euro Stocks 50, which is basically the Dow Jones of the Euro stocks or the European Union. It's 50 stocks that are, you know, the equivalents of the AT&Ts, the IBMs of the world. They're the Unilevers and so forth. It was trading around 3,100. After it had suffered a 14% loss. So again, we're looking at something that hasn't maybe had a bear market, but it's been beaten down substantially. Our projection for international stocks at that point in time was about 7% a year. So I took a look at structuring this. And what you're looking at here is on the right side, you've got 2 columns. The left column on the right side is basically your final index return. The right column is how much you would earn. And what you'll notice here is that 80%, let's start with that 80% number. So that 80% down there, which is 1, 2, 3, 4, 5, 6, about 10 rows down or so. If the Euro Stocks 50 on that 5th year anniversary is no worse than a 20% loss, you're going to get a 42% payout. So you're going to get basically 8% a year roughly, and the Euro Stoxx 50 could actually have lost 20%. And this is where these things sound too good to be true. But again, there's the downsides, the risk, the credit risk, the liquidity, and so forth. If it's anything above that, you're going to get at least a 42% payout. If it happens to go more than 42%, if the Euro Stoxx is up more than 42% on that 5th year anniversary, you're going to get point for point, whatever it is. And so as you can see the chart, it kind of shows you the sloping line from lower left to upper right, what the market return is, and the line above that is what the actual structured note return would be. So on the downside, you've got a lot of protection. And then you come into this range where down 20 to up 42, you're making 42%, no matter what, subject to the risks that we discussed. And then above that, you're just making point for point. So you've got downside protection, a very high likelihood of getting that roughly 8% a year. And then if the Euro Stoxx 50 does better, you could do better. So this was something that interests me as the international market was just getting hammered, because in my mind, I felt that the downside was a little bit less, and I wanted to give that likelihood of beating our projections for your financial plan. The one that I just did recently is the worst of the S&P or the Dow. So this is a BARCLAYS structured note. And what this is, it's called a buffered note. It's got a hard 10% hard buffer, meaning that the worst, we're taking the S&P 500 and the Dow Jones, the worst performer. Forget about who does better. It's the worst performer of those two. If the worst is not down, it's a 4-year note, more than 10%, you're going to get all your money back at least. So it could be down 10%, you get 100% of your principal back. If it's down more than 10%, you would lose point for point past that. So if it's down 15, if the S&P is down 8 and the Dow is down 15, they use the Dow and you would lose 5%. Not 15, you would lose 5. On the upside, what you get is a 32% payout. Anything that is flat, it's a 0% return to a positive 32, you're going to get 32%. So if the worst of the S&P or Dow does 5% on that 4th year anniversary, you're going to get 32. If it does 15, you're going to get 32. If it does 32, you're going to get 32. And the neat part about that is anything above 32, you get a leverage factor of 1.27. So immediately, once you cross 32%, and which you'll see the stats in a second, you're going to get 1.27% of whatever the index does. So that gives you a leverage factor on the upside. What I pointed out here, though, it's the same type of chart. You got your lower left sloping upward right line. The blue is whatever the return of the market is. The green is whatever the return of the index would be. You've got 2 of those triangles there, which I pointed out. Those are the periods in time. Those are the events that we hope to avoid, because if we hit those events, then you actually would be worse off. Anything outside of those 2 triangles, you're going to be better off, which happens to be about 91% of the time on this chart. And again, on the bottom, we just used the S&P 500 return. I didn't have the Dow data going back, but we used the S&P 500. You could assume that the Dow, throwing in the worst of the 2, would be a little bit worse. However, you could also assume that it would be a little bit better. So they're going to be very highly correlated, those 2 indexes. It's about a 95% correlation. So they're going to be very, very close. And the reason that we would use 2 indexes is it gives you a little bit better bells and whistles. So we take a little bit more risk, but we get a little bit better bells and whistles. As you can see from the chart, there's only those 2 triangles where you would actually be worse off. And in your thought process of we're going to have a sideways market, well, if we have a sideways market and the worst is up 10% or up 15%, you're going to get that 32% payout. So that 8% per year is higher than our US stock market projections. Granted, we have not taken into account compounding of interest, which would reduce that a little bit. It would bring the structured note back a little bit more to earth. However, we're trying to rein in returns, and this is something that specifically for retirees and close to retirees, that's what we want to do. We don't necessarily need all the upside, although this provides that too, but we want to rein in the returns and still get a plan that works for us using these. If we looked at back testing of this concept, so the 10% loss, 0 to -10, you get all your money back. Anything worse than 10, you get point for point, you lose. So -11, you lose 1. And anything positive, 0 to 32, you get the 32% payout. Anything above that, you get a leverage factor. So we looked at the back testing of this, and it's really fascinating. The chart on the bottom, you can see the yellow and the blue. Those are the Dow Jones and the S&P 500. they track very, very similarly. So using the worst of those two doesn't really faze me too much. And then above that, you've also got the dispersion of your returns of the worst. So that's the dispersion of the worst of the S&P and the Dow Jones. And then the numbers break down like this. About 14% of the time, you're going to be down more than 10%. So you're going to have a loss. However, anything down more than 10%, you're still better off than if you would have just owned the S&P 500 or the Dow Jones, because it would be down more than 10% as well, except for there's no structured note to give you any buffer. And that's after taking advantage or taking into consideration the loss of dividends as well. So anything more, so about 14% of the time, you're going to be worse off. About 6% of the time, you're going to fall in that gray zone, that 0 to loss of 10%. We don't really want to be in there. That's where one of the triangles was, but that's about 6% of the time. About 20% of the time, you're going to be 0 to plus 30. So that means you're going to get a 30% payout, 32% payout, 20% of the time, historically speaking, obviously. And about almost 60% of the time, you're going to be above 30. Now, granted, this note was a 32% digital, so take away some of that 58% because some of those fell between 30 and 32, but it's a very high number that gets you that leverage factor. And going back to that chart, if you look at the leverage factor, if we do achieve that, if the worst of the S&P or Dow is just a hair over 32, all of a sudden your return jumps up into the 40s, and now you've got a 10% per year average, or excuse me, 10% per year annual return out of that structured note, whereas the S&P Dow may only do 8, it may only do 7, or it may only do 9. So that's one of the things that we look at when structuring these notes. Moving on, where can you invest in these notes? You can get them in a lot of different places. You can get them at Schwab, Fidelity, TD Ameritrade. We custody with TD Ameritrade, but our notes are issued by the big banks, so we actually have to connect the big banks, BARCLAYS and Goldman, with TD Ameritrade to get them to create the note. Then they put the note over to TD Ameritrade. TD Ameritrade puts it into our client accounts. You can go direct to the big banks. They love selling these things because, number one, they get financing. So they're getting capital to go out and grow their business. So they're very happy to sell these notes, but they quickly turn into a commission product or a proprietary product because that's what they want to sell. They want to sell those notes because they're their notes, and that's how they make the most money. Personally, I prefer to shop the banks. I like to price shop. And so we're not tied to any big bank. We want to diversify. We want to layer these in, and we want to get the best pricing on the bells and whistles on these notes. But you can get them most anywhere. So we talked a little bit about the bad rap as I kind of bring this all home. The bad rap, a lot of the news out there focuses on the Wells Fargo structured notes, and what they basically were doing is they were creating a structured note. They were getting a 3% commission, and then after a year, before it was even matured, they would say, oh, let's sell the structured note and go into this new structured note. So it's basically they were churning structured notes. They would get 3% a year off of churning these things. So they got sued, they got in trouble. We don't do that. That's just not our structured note. So if you stumble across stuff like that, that's just, there's bad stuff everywhere in the industry. You can say the same thing about selling annuities or overpriced mutual funds. The big story that pops up of why structured notes are horrible is people had structured notes in Lehman Brothers back in 2008. And obviously, as you probably remember, Lehman Brothers went belly up in the Great Recession. People lost all of their money in those structured notes. That is possible. That's why we focus on that as the number one risk. I can make an argument, however, that if you had a $10,000 investment into a Lehman structured note, similar to the ones that I just mentioned, if you had a $10,000 investment and in that point in time in 2008, you were probably down 30, 40, 50% anyways, your investment would have been worth 30, 40, 50, 60% less than that $10,000 anyways. So if your investment, if you just stayed with the market, was down 50%, you didn't lose 10,000, you lost 5,000. That's the way that I look at it. I'm not trying to justify it. I'm just pointing out that the Lehman note went belly up. It's all over the internet. That's just part of the risks. That's also part of the reason we don't put $50,000 unless you had multi-millions into one structured note. We want to diversify that credit risk. So the other thing that you'll see on the internet is a lot of the naysayers. They'll tell you, well, you lose the dividends and you lock yourself up and they're illiquid and you got the risk. You got to have an extra benefit for the risk that you're taking with the credit risk to make it worthwhile. So there's a lot of negativity on that, and I get it all, and it all kind of makes sense, but that's why we don't use the commission products. That's why we look at the analysis. That's why we include the dividends, and we realize that we are losing those dividends before we step into any of these notes. And so I think they're misrepresented a lot as well by brokers who are just trying to sell them for that 3 or 5% commission. And I think they're misunderstood by investors. A lot of the negative stuff on the Lehman stuff was they were quote unquote principal protected notes. Well, again, the principal protected is only subject to the credit of Lehman. So they're not principal protected unless you're literally comparing that to a Lehman Brothers bond, a corporate bond. In which case you would expect if Lehman went out of business that you would lose 100%. So they're definitely misrepresented by brokers who have ulterior agendas, kind of like the Wells Fargo situation, and they're definitely misunderstood by the public at large. Our whole purpose here is to bring you an investment idea that can enhance your returns, that can give you some downside protection, that in small amounts can improve your performance overall. That's our goal here, and that's why we use structured notes as a small diversifying component of our portfolio. And over time, we hope to enhance your returns, to give you that downside protection. So that's all I have for you today on the webinar on structured notes. Hope you learned something. Appreciate you sharing your day with me or your time with me. And if you have any questions, please go ahead and shoot them over, Greg@redrockwealth.com. Thank you very much.